Welcome to this Killik Explains finance video. This week, why most investors should not own alternatives. Right, let's get straight in there. So, big world of choice. On the left-hand side, what I call conventional assets. So most people who want to invest their wealth decide to go for some combination of shares, bonds, cash, and in a few cases, property. More about property in a moment. I've put it on the left, but it shares some features, one could argue, with things on the right. Now, alternative assets. This is where people come along to you and say, well, why don't you do something a bit more exciting in investment terms? Why don't you buy one of these and invest in it? Cars, vintage cars, for example, antiques, jewellery, books, arts, and violins. And essentially, I'm going to be arguing, by all means, buy something on the right if you intend to enjoy it and you can afford to. But be very careful about treating it as any kind of conventional or even bolt-on investment. Now, key practical differences first of all. Now, this is pretty obvious stuff, but let's take a look at it anyway. The advantage of the conventional assets on the left of that slide I just put up, with the possible exception of property, which I will come back to because it's a popular asset class, they're relatively easy to buy. Setting up a portfolio of shares, buying an index fund, for example, is not that difficult and doesn't have to be that expensive. They're relatively easy to own and manage. They're not completely hassle-free. You do need to rebalance portfolios. You need to review your tactical asset allocations and so on. You don't just sort of lock up and leave it. But compared to some of those other alternative assets, it's relatively straightforward. And finally, they usually pay an income. Shares offer you dividends, for example. Not in all cases, but in a lot of cases. Bonds usually offer coupons, and cash pays a little bit of interest. And if you buy an investment property, you'll get some sort of rental yield from it. Although bear in mind that if you own a property to live in it, well, the most you could say is you get some kind of imputed rental benefit instead. So those are the major advantages associated with sort of conventional assets. Now, practical considerations. Were you to think about dabbling in some of those alternative asset classes, you need to think about the fact they're difficult to buy well as a novice. There are a lot of sharks out there. I mean, do you know, for example, if a vintage Jag has its original seats or not? Because you can fit it with seats which look pretty convincing to most people. Do you know what a genuine piece of art looks like? How good at wine actually are you beyond standard dinner party fare and so on? They can be expensive to own and store. Take cars, for example. You can't just leave an expensive vintage car parked on the street, or it's unwise. Most people need to store it, vacuum seal it, have it maintained, secured, and so on. And there's no income. All right, cars, violins, antiques, and art don't generate an income. And that can make them more difficult to value, more subjective, as well as limit their value from an investment perspective. But that won't stop people trying to get you into some of those more exotic assets. Now, what about returns? For most investors, it comes down to this. How much money could I expect to make? Now, the past is no guide to the future. Things go down as well as up. Standard caveats apply. But nonetheless, look at this. This is a study done from 1900 through to 2017, so a pretty big study period, by Credit Suisse in their Global Investment Returns Yearbook for 2018. And what they found is this. On the left-hand side, this is basically a benchmark, if you like, looking at price indices in real US dollar terms, US dollar being the dominant trading asset in the world, if you like, on a total return basis. So where they can, where it's relevant, they've factored in income as well as capital gains. And look what you've got out on the left-hand side here. There's equities comfortably outperforming all of those alternatives. Now, admittedly, cars, vintage cars, have more recently given equities a sort of decent run for their money, but then it all tails away. There's the average. Really, the numbers are less important. You can see how small the pink blobs are. And some of you will be screaming at me, surely not. Out on the right-hand side, there is property. I'm going to say a bit more about this in just a moment. But the point being, past is no guide to the future. It is a long study period and so on. But equities seem to have done a reasonable job with the right sort of investor behaviour, which I cover in other videos, of generating total annual real returns. Now, if you want to see annual real returns, we need to flick on in this study to a slide more like this. So, according to Credit Suisse, past no guide to the future and so on with that caveat, world equities on a TRR, total return basis, there it is, 5.2%, that's inflation adjusted. Now, collectibles, that's bracketing all of those other alternatives together, come in at 2.9%, not bad. All right, certainly beats cash, but some way off equities. Bonds are in there, at 2%, all right, and then property, some would be thinking surely not, 1.3%. Now, let me say some things about that. First of all, how have they derived the 1.3% number? Because I know property is popular out there. They've looked at 11 countries, including the UK and the US and Australia and a load of European countries, and come up with an average. It is city-based only, real inflation adjusted, price only across 11 countries before costs. Now, if you took costs into account, that number would actually drop rather than rise, but equally, oh, and by the way, if you also factored in rural areas as well as cities, it would drop again, but in fairness, it is an 11-country average. Take out just the UK, and it rises to 1.8%. And were you to look at the period, the buy-to-let bubble, as I call it, of 1995 to 2007, it rises to a much more impressive 6.2%. But for reasons I cover in another video, I think buy-to-let these days is only for people who know what they're doing and or very brave investors, frankly. That period from the mid-90s was a bit of a one-off, and as I say, there's another video where I explain exactly why. So there you have it, a few caveats around the property number there. Now, where is property now, if you like? Well, Credit Suisse sort of agree with me, if you like, said, you know, that period was a little bit unique in the UK. So they see, for these 11 countries, if you like, property sitting in the future somewhere between bonds and equities. Okay, so with that in mind, other factors, right? Other factors to bear in mind. Collectibles are not all about returns for some people. So they can provide wealth conservation. They can provide financial diversification. So for very, very wealthy investors who've already got a decent allocation to all those other asset classes, the conventional ones I mentioned, there is a degree of diversification. Why? Because those other alternative assets don't always behave the same way as conventional ones. And there's the gratification factor. All right, people like to show off and say, I own an expensive vintage car, work of art, and so on. And actually, gratification is important. There's no harm in buying some of those alternative assets if your objective is to enjoy them. And that brings me on to some concluding thoughts. So, in conclusion, basically, most UK investors, yes, own your main home if you can. Certainly say that. Keep sufficient rainy day reserves in cash or short-dated bonds to cover that leaky roof, loss of job, and so on. Most of the rest of your wealth, long-term, your lifetime savings, should be in a diversified portfolio of shares and bonds, weighted according to your future drawdown needs. I cover more on that in other videos. Most novices in particular, most mortal investors should not hold a lot of cash. I've covered why in other videos. It is the underperforming asset class, even looking across a wide spectrum that includes alternatives. Be too conservative over a long investment horizon. People are still heading towards retirement, mid-50s, and thinking they need to go all cautious in terms of their investment strategy, and the reality is they might be investing for another 30 years, and so on. Own alternatives other than for pure enjoyment. By all means, if you have a passion for wine, art, antiques, violins, and you're going to buy them and enjoy them, great. But as an investment, be very, very careful. And owning property for pure investment purposes, I would say, is out of bounds for most normal investors. It can be illiquid, it can be expensive to buy and own, you get void periods, and anyone who uses that sort of one-off buy-to-let boom period as a way of marketing property as an easy to manage and own investment with decent returns, I think is misleading you. So, with that caveat in mind, any questions? editor@killik.com. And if you'd like to watch videos on a range of related topics, including that buy-to-let video I mentioned, which is my personal view, but I stand by that personal view, then it's killik.com/learn.